All right, welcome back. It's day 4 of the Market Mastery series. Today, we're going to talk about just 2 lines. That's it. But I promise you, these 2 lines are so powerful, they can pretty much tell you the story behind any stock chart you'll ever look at. So let's jump right in. So yesterday, we were talking big picture, right? Bull markets, bear markets, the overall tide of the market. But today, we're zooming way in. We're getting down to the nitty-gritty, the exact spots on the chart where the real fights happen, the battle lines where you can actually start making some decisions. And look, if your brain is fried and you can only remember one thing from this entire series, make it this. I'm serious. This is the absolute foundation of reading a chart. It works on everything, stocks, indices, you name it, from a 5-minute chart to a 5-year one. This is the bedrock. So what are we talking about? 2 simple ideas, support and resistance. The easiest way to think about it is as a floor and a ceiling for the price. Support is the floor, where buyers step in and hold things up. Resistance is the ceiling, where sellers take over and push it back down. Let's break that down even more. Okay, let's start with support. Just picture a bouncing ball. Support is literally the floor. The price is dropping, 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 and then thump. It hits a certain price level and bounces right back up. Why? Because that's where all the buyers are waiting. They see that price and think, yep, that's a good deal, I'm buying. For instance, you might see the Nifty index drop to 22,500 and bounce, not just once, but 2, maybe 3 times. That, my friend, is a strong floor. That's support. And resistance, as you've probably guessed, is the exact opposite. It's the ceiling. The price is climbing, everything's looking great, and then, bonk, it hits its head and falls back down. This happens because the sellers see that price and think, okay, this is getting a little expensive, good time to cash out. You might see a stock try to get past 1,500 rupees over and over again, but it just can't do it. That 1,500 level, that's your ceiling. That's resistance.
Okay, so you've got the floor and the ceiling. Simple enough, right? But here comes the really cool part, the part that honestly changes the whole game. What happens when the ball breaks through the floor or smashes through the ceiling? You need to pay close attention right here. This is the secret sauce.
So imagine you've got this solid floor, this support level that's been holding strong, but then one day, crash. The price just slices right through it. What happens then? It completely flips its job. The old floor is now the new ceiling. Mind-blowing, right? That exact same price level that was a safety net holding the price up now becomes a massive barrier pushing the price down anytime it tries to climb back. It's like the room just turned upside down. And yes, it works exactly the same in reverse. When the price finally gets enough momentum to smash right through that tough ceiling, what happens? That old ceiling becomes the new floor. It's incredible. So if the Nifty finally breaks above that stubborn 22,500 resistance, you'll often see it come back down, tap that same level from above, and then use it as a launch pad to go even higher. Now, I know what you might be thinking. Okay, this sounds a little bit like Ludo. Is it just random lines on a chart? Is this stuff magic? And the answer is no, not at all. There is a very real, very human reason this happens over and over again. It is pure human psychology. See, traders remember prices. If you bought something at a certain level and made money, you're gonna want to buy there again. Then you've got regret. All the people who hesitated and missed the last bounce are sitting there kicking themselves, promising they'll buy if it ever gets back to that price. And maybe the most powerful force of all, pain and relief. When a support level breaks, everyone who bought there is now losing money. They're just praying for the price to get back to where they bought so they can sell and just get their money back. That creates a huge wall of sellers at the exact same spot that used to be the floor. So how do you actually use this today? It's a dead simple 4-step plan. Number 1, find the floor. Look for where the price has bounced up multiple times. 2, find the ceiling. Where did it get rejected? 3, and this is key, make your moves near these levels. The area in the middle is just confusing noise. And 4, never ever forget the flip. The moment a level breaks, its entire role reverses. Now, before you open up your charts and start drawing lines all over the place, let me save you from a huge mistake that I see pretty much everyone make when they first learn this. Please, remember this. Your chart is not a zebra. Don't go drawing 20 different lines on it. You will just confuse yourself. Here's a simple rule of thumb. If it's not obvious, it's not important. The really powerful support and resistance levels should practically jump off the chart at you. You shouldn't have to squint to find them. Keep it simple. Okay, homework time. And I mean right now. Go ahead and pause this if you need to. I want you to open up any chart. Could be Nifty, could be Reliance, Infosys. It really doesn't matter one bit. And your mission, should you choose to accept it, is super simple. Just find and mark one. Just one obvious floor and one obvious ceiling. That's it. Don't overthink it. The goal here is just to start training your eyes to spot these key battlegrounds for yourself. So as we wrap up day 4, I've got a question for you. Be honest with yourself. Was this whole concept new to you, or did you already know about the flip? Either way, just by understanding this one thing, you are already miles ahead of most beginners. You're building a fantastic foundation. Great work today, and I'll catch you tomorrow for day 5.